We've had a huge rally in the S&Ps of over 300 points in the last week. What's the market's next move? Welcome to Doc's Market Minute for Wednesday, the 23rd of March. Let's begin by getting a little bit of context about the current chart. This is the S&P 500 for the past 5 years or so. And what we can see is during that time, starting in 2018, we had a pretty significant correction, which bounced back up almost to new highs and then had to retest the low before recovering. Okay, so that's one example. And we did that again later on that year where we had a bounce back up, and then it drove to new lows, down about 20% for that one. Then we're all familiar with the pandemic correction, which did not retest the lows. It just bounced straight off of there in a V bottom. Since that point, we've had some smaller corrections, which retested the bottom once again. And everything since that point in the fall of 2020 has been on the order of, say, 5% or so. So we're not going to count those. So this has been about a 14 to 15% correction on the S&P if we count tip to tail. So obviously the biggest question from here for most traders is going to be, are we going to drive to new highs, or are we going to retest the lows and maybe even drop down to a 20% haircut? So let's provide some structure to be able to answer that question. I've zoomed into the S&P 500 futures over the last couple of months. And the first thing I'd like to talk to you about is the Fibonacci retracement. So from the very highs of the market, which was on the 4th of January, let's look at the first move down, which terminated somewhere around the 24th of January, I do believe. Now, what I want you to focus on is for this initial swing down from the beginning to the end, there's retracements here, which are designated by 23.6%, 38.2%, 50%, which yes, is not a fib number, but we're going to include it anyway. And then finally, 61.8%. Notice how the price eventually came right up to the 61.8% retracement and could not get through there. This is a very important number. This represents essentially the delineation between the last line of defense for the bears and new highs for the bulls at that time. The way that we look at the 61.8% fib retracement is if the price goes past that level and closes past that level, then it's more than likely going to fill in the triangle. And when I say fill in the triangle, this is similar to what we saw back in the pandemic bottom, where we got this big V bottom. Once the price got past the 61.8% retracement, it was a higher probability that we were going to fill in the triangle and go right back to the all-time highs before the pandemic. Okay, so now that you understand the 61.8% number, let's apply this towards today. Now, what I'm going to do is I'm going to take this number because the February lows were actually much lower. So all the way down here, now we have the full tip to tail number for this 14.69% correction. As a result, we've changed our fib retracements. Now we have the 38.2, which is lower, 50% is lower, as is the 61.8% retracement for the entire swing now, which goes from tip to tail all the way down here. So if we were to look at a weekly chart, this would all make more sense. So what I want you to focus on here is, again, the 61.8% retracement, which is right around 45.40. We can just roughly call it that price level, 45.40. The price appears today to have stopped just short of that level. So that's the level that we're going to use to determine whether or not the price is going to fill in the larger triangle, in this case, maybe the weekly triangle, or find itself resistance and go back down into a 20% correction. So what I'm going to do is I'm going to leave this yellow marker right there, and I'm going to get rid of these fibs now and focus on the fibs from the bottom. So this is a completely different equation now. Now we're going to take these fib retracements from the very bottom of the move, which was the previous Monday, and take them up to today's highs, assuming that this is the top of the current swing. Now we have the same logic in reverse. It's very common for us to see pullbacks maybe at 38.2% or 50%, or maybe even as far as the 61.8% retracement. These are all valid pullbacks in an impulse swing like this. Now, frankly, I'd like to see the price bounce at the 38.2 retracement, or perhaps consolidate in a very tight little range up here, creating either a horizontal box pattern or a bull flag. Either of those are fine. But even if it does pull down to the 38.2% retracement, I'm still good with that, because we have the price putting in a higher low down here and now a higher high, which is above the descending trend line. This is the beginning of a change in polarity to an uptrend. We now have a higher high and a higher low. That's all good. So the highest probability move at this point would be some type of a pullback or some type of consolidation to create a higher low followed by a higher high. Now, if this does set up like this, here's where it's interesting. If this does set up like this, if we do pull back like this and everything looks good, this must drive into a new high. This move must drive into a new high. If it does not, then what we could be seeing is a failure at that point, in which case this whole pattern here would be a monthly lower high. This is where we'd create a massive bull trap, and you'd see the price rapidly drop down, more than likely to a 20% correction or worse. So again, guys, in conclusion, the highest likelihood that we're going to see is some type of a pullback in the short term, followed by what should be new highs. And if it gets above that 61.8% retracement at 45.40, then things look good for higher prices into the second quarter. However, after the pullback, if that does not create a new higher high, if instead the price drops into a lower high up here, if it drops up into a lower high, then more than likely we are heading down from here. And this is going to be a direction that very few people will anticipate. Most people use technical analysis the wrong way. They think it's for making predictions. It is not. It is for setting up price levels so you can be prepared and proactive about making decisions. Thanks for listening to my Market Minute. We'll see you in the next one.